Awesome. Start whenever you're ready.
Okay. Well, good afternoon, gentlemen. We're excited to be here in Spokane for the CFA competition. My name is Andrew. These are my teammates, Jerem, Euban, and Eduardo. And today we'll be presenting our analysis of radius recycling.
Thank you so much, Andrew. So we've decided to issue a cell rating to Radius Recycling's share. Their price on our date of analysis was $26.25. Our 12-month target price is $25 per share, with the price on February 20th was $20.59. And the reason we have chosen to issue this recommendation is due to increased pressure on operations needing additional leverage to sustain themselves through a difficult economy and a volatile supply chain. We'd also like to point out their share price over the last year has seen a declining trend with a beta of 1.127, and yesterday they hit a new 52-week low.
A little bit of background for the company. Radius Recycling is based out of Portland, Oregon, and has spread throughout the United States and parts of Western Canada. This includes Puerto Rico and Hawaii. Their business model is based on taking construction scraps and automotive and other recyclable materials and shutting them down into ferrous and non-ferrous metals for steel production and others.
So now we have the industry overview and competitive positioning of quarter five forces for Radius Recycle. We would like to start off by stating that RDUS is in an oligopoly market, and being in the oligopoly market, the threat of new entries is relatively low since there's only a handful of large players. Bargaining power of buyers is relatively low. Threat of substitute products or services is relatively low, and we'll be covering in the later slides, but since it's metals, the only really way to differentiate is the quality of the metal and the ESG. Industry intensity of the competitive rivalry we also consider to be very moderate. A lot of the smaller players in this industry are having a hard time meeting the ESG regulations, and it's being acquired by the larger, more established companies. And the larger and the more established companies are more likely to compete in the future, so they will have rivalry, but it's not like they're going to be a new competitor in the business. And bargaining power for suppliers we consider to be moderate. Moving on is investment summary. The first thing I would like to highlight is the operational and economical challenges for RDUS. So RDUS, companies like RDUS is considered to be urban recycling. What that means is they collect scrap metal as economic activities happen. The chart to the right is from Federal Reserve economic projection of December 2023. On the orange line, you can see the Federal Reserve predicts American GDP to grow by 1.8% to 2025, 26, and in the long run. Historically, US GDP has been a little over 2%, so it does show a downtrend, but this is not just in the United States. It can be seen in other parts of the world, such as China and Turkey and India. And the reason why we state that is because 80% of RDUS is being exported to China, Turkey, Malaysia, and India, and that's why we stated. And the following 2 and 3, Turkey's steel industry under constraint and stagflation in Turkey. And next I will be covering the concerns over increased debt ratio and the liquidity concern overview.
Thank you so much, Euban. That was a perfect segue into our financial analysis of Radius Recycling. So, like he had mentioned, there are concerns over their increased debt ratio. Through our meeting with Michael, the Senior Vice President of Investor Relations, he shared with us that they're planning on increasing their net debt ratio from 23.58% to 30% net debt ratio. They're using this debt to merge and acquire with other steel recycling and scrap supplying firms so that they can sustain themselves through the steel market economy. We see this as a danger and a sell pressure on the share price because we see their interest expenses have already multiplied and grown substantially, making it increasingly difficult to service this debt, especially during a difficult economic period. And then finally, in terms of ratios, their 12-month trailing PE was 32.45, and their earnings per share was only 85 cents per share. Compare that with the steel industry median PE of 10.41 and median earnings per share of $3.38 could be a significant indication that Radius' share price is overvalued at time of analysis.
Yes, so the capital structure on Radius is, it was mentioned that they made some investments. They want to make some technological improvements on their non-ferrous. So they initiated their investments, which cost money. Then the other ones, they, like mentioned, they acquired metal recycling facilities. And as you can see, there an increase in the number of locations. And one of the things we wanted to focus on is they started taking on more debt, more interest. Their debt started to run up, their equity started to run up in assets. And one of the things that we start to notice in their trend is that they increase on all these firms, all these locations, but their sales actually started to come down. And one of the things that we could see like an obvious dip in from quarter two to quarter three in 2022, and a lot of it had to do with their non-ferrous exports, which the prices fell by 40%, along with other economical issues. And so see on this one, we can see that they increase again net equity, equity, assets and debt. And but one of the things that actually started not doing so well was their sales, their EBIT and net income, which explains the negative downturn in ROE and ROA, and negative in the last quarter due to negative earnings. And so one of the things that I wanted to focus on here is contractual obligations, but it's more like the bigger picture, is they increase their interest, they're increasing their debt, and this is one of them that doesn't show up on their debt. It's contractual obligations, and we can see it has increased tremendously from 2021 to 2023. And we could add to this that this is just adding to the pressure that they're just having all these obligations that they need to meet, but their sales are not performing.
Thank you so much, Eduardo. With all this in mind, we now like to talk about how we came up with our valuation for Radius Recycling and address some more investment risks along with this. So we used 4 different valuation methods to come up to our fair price of $25 per share, and we have ranked them based on the weights we have issued to them. The highest weight was the book value of Radius's share. Like Eduardo had mentioned, Radius has been spending and investing a lot in purchasing long-term plant, property, equipment, long-term assets. They have a lot of these assets on hand, they just haven't been able to leverage them into producing revenue and then cutting their margins to, increasing their margins to generate more profit. And then we ran a dividend discounted cash flow model using their 6.9% weighted average cost of capital and as the discount rate, and then the 4.53% treasury yield at the time of analysis for the risk-free rate. And then we used EBITDA multiples and a Monte Carlo simulation. Applying each of those predicted prices with their weights, we have arrived at our fair value of $25 per share.
These are the risks that are associated with RDUS that we think that the investor should be aware of. I would like to focus on number 2, 4, and 5, supply chain challenges, expansion into electrical vehicle recycling, and commodity price volatility. So number 2, we have supply chain challenges. As mentioned earlier, supply chain challenges has to do with a lot of the economical activity slowing down. PMI is also under 50. It's not performing where it used to be. Expansion into electrical vehicle recycling. As we all know, electrical vehicle has batteries and other parts that has more steel than internal combustion engine. However, the electrical vehicle has only been starting to sell at a mass scale in the last couple of years. And for a vehicle to come to these scrap metals, these end-of-life vehicles, it takes about 12 to 15 years. But we do think with the highly changing ESG regulations that the electrical vehicle may not be seen in the quantities that we would like to see in the future. Commodity price volatility, RDUS does not hedge their commodity price, their metal prices, and therefore whether the metal prices go up or down, they are exposed to risk of that volatility in the metal, which could highly affect their margins.
Thank you, Yuban. Now we want to talk a little bit about environmental, social, and governance. Bloomberg gives Radius Recycling an ESG score of 3.52 out of 10. Governance, this is above median for their waste management peer group. Governance is especially leading. Social and environmental are lower, but still above median for the peer group. And here we have a few select peers in the waste management industry. They have received numerous awards for ESG. Most importantly is the AAA ESG rating from MSCI. They were also named World's Most Sustainable Company by Corporate Knights. Their environmental standpoint is doing well based on a few of these things, especially their emissions reduction. In 2019, they set an emissions reduction target of 25%. They surpassed that in 2023, and they've now revised that to be 35% emissions reduction by 2028. 92% of their electricity is renewably sourced from hydro and nuclear and other sources, and the other 8% is offset by the purchase of renewable energy credits.
Awesome, thank you so much, Andrew. In conclusion, 2024 will be a very tumultuous year for Radius Recycling's operations. Increasing liabilities will be increasingly more difficult to service, and various risky events that we foresee happening in 2024 will put this increase downward pressure on their share price. Thank you.
Thank you.
Great job, guys. Yeah, we'll open it up to the panel for questions.
Maybe I'll start. So you mentioned the concern was increased debt for M&A to help consolidate the industry. I don't think you mentioned it, but I believe they pay a dividend. What are your thoughts on paying a dividend versus your concerns that they have too much debt and they're building their debt book? I guess how would you think about that?
Yes, sir. They pay a 75-cent cash dividend every year, and that was what we use as the precipice for our dividend discount model. However, we have definitely thought, and our encouragement would be to refrain from paying a cash dividend. They have authorized share buybacks, but have not. They've authorized 9 million shares in buybacks. They've only purchased 900,000, and so we would think that a cash dividend isn't the best option for Radius to be redistributing their retained earnings, especially when the retained earnings are negative earnings.
Yeah, thanks guys. On the capital structure changes, I was looking at the operating facilities. It looks like they have 3 business segments. Can you talk a little bit about the steel facilities one? That seems to be,
Yeah, for sure. So Radius Recycling obviously operates mostly with metals recycling, but more recently they've been expanding into actual steel production using those ferrous materials that they've recycled and actually producing rebar and other steel products, and as well as their new green steel line, which is net zero carbon emission products. So that's something that they will probably be doing more in the coming years, is more steel production as well.
So to add on to that, the yellow ones are like your scrap and pull, right? So if you have an end of life vehicle, that's where you basically take to sell it for junk and sell it for metal. The oranges are your shredders, so these would include like scrap metal that are collected from more like manufacturing, heavy manufacturing materials. So those would be collected through the oranges.
Maybe I didn't understand Bo's question, but you guys focus on their debt profile. In terms of their debt, do they have fixed rate or revolving debt in terms of for them to raise additional debt going forward? Are they going to be taking more interest rate risk going forward in terms of if they were to do a debt raise?
Yes, sir. They do not have any publicly traded debt. They have no bond rating. Their debt is, they use interest rate swaps to peg a fixed rate on all of their debt. And so they had a fixed rate on their debt prior to 2022, and they began to increase their leverage. And going forward, they have no plans on using investment banks to issue public debt. They are going to continue to use interest rate swaps to peg those fixed rates on loans and other long-term obligations, as long-term debt makes up 25% of their capital structure, their weighted average cost of capital.
So you just do it all on the banking side?
Yes, sir.
So this is truly, I'm not trying, I'm very curious. So your guys' forecast is that electric vehicle demand is gonna go down going forward, or just that relative to kind of Wall Street expectations that?
Relative to Wall Street expectations. So Wall Street expectations, right? By 2020, it's like Europe is no longer going to approve the internal combustion engine, but there has been a lot of changes in regulations, and we see that demand to basically the forecast that's predicted from Wall Street to change a little future a little bit. Also, since electrical vehicles are not your traditional internal combustion engines, when it comes to like battery issues and things, we might see them showing up at the scrap metals a little earlier, because when there's an issue with the battery, it costs more to have the issues fixed. But what we're trying to point out is that investments in like battery recycling technology is very new, and investing in those sectors may be a little premature at this point.
okay. On your guys' evaluation approach, which I really liked, you gave the heaviest weight to book value. Do you want to walk me through your thought process on that?
Yes, sir. I'd love to. Our process was we gave book value the heaviest weighting because we had mentioned Radius has been spending so much time in the last few years just acquiring assets, acquiring plants, building these steel production and scrap recycling facilities. We believe the company has a high potential to create much value and high intrinsic value. So this was the heaviest weight we gave, more on the balance sheet side of their valuation, but these three are more on the income statement side because these describe the variability and the cash flow side of their earnings and operations. And so we didn't give them as high of a weight because we do want to give Radius that benefit of having that high intrinsic value. They just haven't been able to employ it in a way that.
Do you guys know how their book value, how much of it's tangible and how much of it's goodwill?
That is a great question. I do have their balance sheet here.
Because generally companies that do numerous acquisitions, there's a lot of goodwill as they come to.
So, out of their total assets, they're non-current, they have 67.9% non-current, 32.1% is current assets. Their goodwill would be in the other long-term assets, so they have 20% in those other intangible long-term assets.
Okay.
You guys talked about commodity prices, I think, being a risk. Did you guys run a correlation with a commodity index of any sort?
Oh, yeah, sorry.
So you mean like correlation with like maybe like the stock price with like the metal industry?
Yeah.
So we have not, but we don't have a chart for it to visually show you, but RDUS seems to have a little more deviation than the other companies that are in the sector. Some other companies does seem to follow the trend of the commodity metal price, but it looks like RDUS has a harder time following with the correlation when it comes to correlation with the metal price.
You mind if I add on to that as well? With like what you've been said, we see here the price of steel. We saw something interesting happen in December of 23 when U.S. Steel was acquired by Nippon Steel in Japan, and that was what caused, it was the catalyst of this large spike in their share price. As a result, we saw a divergence. The companies that the market really liked tended to keep climbing. The companies the market didn't really seem to like came down. Nucor Steel is one of Radius's top competitors, U.S. Steel as well. Their share prices continued to climb while Radius's fell. And so we believe that Radius is more correlated to the steel price because they have that exposure to the price volatility, whereas other firms are better equipped to hedge and shield themselves from that risk.
Yeah, we got 2 more minutes.
So if you were to continue monitoring the company for the next year or two, what factors would you need to see to turn your stock recognition into a buy, for example?
Yes, so on that one, a lot of it, we could see that they took on a lot of investments, a lot of new properties, they initiated, a lot of it had to do with the ESG and some of the problems that they had, but mostly we believe a lot of those debts could be costing them a lot of money. A lot of the properties too, they also took on an X number of employees when they made those acquisitions, and so that's costing them a lot of money. Last year, they have some improvements, but in 2023, they mentioned that part of the reason why they also didn't meet the desired net income was because increase in wages, higher wages. So then they have all these new extra properties. So for us to change from a sale to a buy, they'll have to make some movements like selling some of those properties, selling some of the debt that's costing them the most, getting basically rid of some of the liabilities, contractual obligations.
And again, we do recognize that the stock price has fallen to a 52-week low as of yesterday. So were we to do our analysis today instead of when we did it, it's totally possible that we would issue a buy rating at this time.
We have 30 seconds if anyone has a quick question.
I like the fact, I don't know, this isn't a question, but the fact that you guys use the St. Louis Fed, which is Fred, as a great resource. I hope you guys continue to use that as resources. We want to encourage a really good
Yes, sir.